How does the stock market work? The purpose of this video is to provide an introduction to the stock market and its fundamental components. We will explore how the stock market operates and cover key concepts that are important to understand. Let us now explore the contents of this video in more detail. This video has been structured in 2 chapters. Chapter 1, about stocks and related components. Chapter 2, about stock market and how it works. Let's jump into the Chapter 1, about stocks and related components. What is a stock or share?
A stock is a financial instrument that represents ownership in a company or corporation and a proportionate claim on its assets and earnings. Stocks are also called shares or equity.
The total value of the company is divided into shares, and each share represents a portion of that value.
For example, if Apple Company has issued a total of 1,000 shares, and you buy 10 shares, then you own 1% of the company.
As a shareholder, you may have certain rights, such as the right to vote on important matters such as the election of board members or major business decisions.
You may also be entitled to a portion of the company's profits, in the form of dividends, if the company chooses to distribute them.
Why companies issue shares? A company sells its shares in the stock market in order to raise capital.
When a company wants to raise money to fund its operations or to invest in growth opportunities, it has a few options.
Borrowing. The company can borrow money from a bank or other lender, but this comes with the obligation to repay the loan with interest.
Equity financing. The company can sell shares of its stock to investors, raising money without incurring debt.
This is known as equity financing, and it can be done privately or publicly. When a company decides to go public and sell shares of its stock on the stock market, it is doing so to raise money from a large number of investors.
The money raised can be used for a variety of purposes, such as expanding operations, investing in research and development, or acquiring other companies. Going public also has other benefits for the company, such as increased visibility, access to capital markets, and the ability to use its stock as currency for acquisitions or as employee compensation.
Types of stock. There are 2 main types of stock: common stock and preferred stock.
Common stock represents ownership in a company and gives shareholders the right to vote on important corporate decisions, such as the election of the board of directors and major business decisions. Common stockholders also have the potential to receive dividends if the company declares them.
However, common stockholders are last in line for payment in the event of bankruptcy or liquidation. Preferred stock represents ownership in a company but typically does not come with voting rights.
Preferred stockholders have a higher claim on company assets and earnings compared to common stockholders, and they are usually paid a fixed dividend that must be paid before any dividends can be paid to common stockholders. Preferred stockholders also have a priority claim on company assets in the event of bankruptcy or liquidation.
In addition to these main types of stock, companies may also issue different classes of stock, such as Class A or Class B shares, which can have different voting rights or dividend payouts. Companies may also issue stocks with different features, such as convertible preferred stock, which can be converted into common stock under certain conditions.
It is important for investors to understand the different types of stock and their associated risks before investing in the stock market.
How share prices are set. The prices of shares in the stock market are primarily determined by supply and demand. When there is more demand for a stock than there is supply, the price typically increases. Conversely, when there is more supply than there is demand, the price typically decreases. The factors that influence supply and demand can be numerous, including company performance. The financial performance of a company, such as revenue growth and profitability, can affect the demand for its shares. Economic conditions. Economic factors, such as interest rates, inflation, and consumer confidence, can also affect the demand for shares. Market sentiment. Investors' emotions and perceptions of the market and the individual stocks can influence demand. Company news. News and events related to a company, such as product launches or legal issues, can affect the demand for its shares. In addition to supply and demand, other factors can also influence share prices. For example, changes in government regulations, geopolitical events, and overall market conditions can all impact stock prices. The price of a share is also influenced by the price at which the most recent trade took place. This price is called the market price or the last traded price. The market price can fluctuate constantly throughout the trading day as investors buy and sell shares. Chapter 2: About stock market and how it works.
What is the stock market? The stock market is a financial marketplace where investors can buy and sell securities such as stocks, bonds, and mutual funds. It is a platform where publicly traded companies can raise capital by selling ownership stakes in the form of shares to investors. The stock market provides a way for investors to invest their money and potentially earn returns through the appreciation of their investments or through dividends paid by the companies they have invested in. Investors can buy and sell shares of publicly traded companies through stock exchanges such as the New York Stock Exchange, NYSE, or the Nasdaq stock market. The stock market is an important component of the global economy as it facilitates the flow of capital between investors and companies. It also serves as an indicator of economic activity and investor sentiment.
How a company sells its share to stock market. When a company decides to sell its shares to the public for the first time, it does so through an initial public offering, IPO. Here are the general steps involved in an IPO. Hire underwriters. The company typically hires one or more investment banks to act as underwriters for the IPO. The underwriters help the company prepare the necessary documentation, such as the prospectus, and help determine the price of the shares. Prepare financial statements. The company must provide detailed financial information about its operations, including its revenue, expenses, assets, and liabilities. This information is included in the prospectus, which is filed with the Securities and Exchange Commission, SEC. Roadshow. The company and its underwriters conduct a roadshow, where they present the investment opportunity to potential investors, such as institutional investors and individual investors. Set the price. Based on demand from investors, the underwriters determine the final price of the shares. This is typically done the night before the IPO. Allocate shares. The underwriters allocate the shares to investors who participated in the IPO. Shares are typically allocated based on demand and the size of the investor's order. Trading. The shares are listed on a stock exchange, such as the New York Stock Exchange, NYSE, or Nasdaq, and begin trading on the day of the IPO. After the IPO, the company's shares are publicly traded, and the company is subject to reporting and disclosure requirements set by the SEC and the stock exchange. The company can continue to sell additional shares in the future through secondary offerings, which can be used to raise additional capital or to provide liquidity for existing shareholders.
Historical stock market trend. The historical trend of the stock market has been generally upward over long periods of time, despite occasional downturns and periods of volatility. Over the past century, the stock market has experienced significant long-term growth, with the S&P 500 index, for example, delivering an average annual return of around 10%. However, many people view the stock market as a form of gambling because they lack financial literacy and do not fully understand how the stock market works. they may see the stock market as a way to quickly make a lot of money without fully understanding the risks involved. However, in reality, investing in the stock market can be a strategic and calculated way to grow wealth over time. Unlike gambling, investing in the stock market involves researching companies, analyzing financial statements, and making informed decisions based on that analysis.
How does the stock market work? The stock market helps companies raise money to fund operations by selling shares of stock, and it creates and sustains wealth for individual investors. Companies raise money on the stock market by selling ownership stakes to investors. These equity stakes are known as shares of stock. As the company grows and becomes more profitable, the value of your share of stock increases, and you can sell your shares for a profit. By listing shares for sale on the stock exchanges that make up the stock market, companies get access to the capital they need to operate and expand their businesses without having to take on debt. In exchange for the privilege of selling stock to the public, companies are required to disclose information and give shareholders a say in how their businesses are run. Investors benefit by exchanging their money for shares on the stock market. As companies put that money to work growing and expanding their businesses, investors reap the benefits as their shares of stock become more valuable over time, leading to capital gains. In addition, companies pay dividends to their shareholders as their profits grow.
Who regulates the stock market? The U.S. stock market is regulated by the Securities and Exchange Commission, SEC, which was established after the 1929 stock market crash and the passing of the Securities Act of 1933. The SEC's regulations govern 4 primary areas: stock exchanges, brokers and dealers, financial advisors, and mutual funds. The SEC's primary mission is to facilitate capital formation, ensure fair and efficient markets, and protect investors. To achieve these goals, the SEC enforces rules that require companies publicly traded on the stock market to provide accurate and truthful information about their business operations. In addition, those who sell and trade securities must treat investors with honesty and fairness in compliance with SEC regulations.
What is a stock market index? A stock market index is a measure of the performance of a particular group of stocks that represent a particular sector, market, or economy. It provides investors with a benchmark to evaluate the overall performance of the stock market or a particular segment of it. A stock market index is calculated based on the performance of a specific group of stocks. The most commonly used stock market indexes include the S&P 500, the Dow Jones Industrial Average (DJIA), and the Nasdaq Composite. The S&P 500 index, for example, tracks the performance of 500 large-cap U.S. stocks across various sectors. The DJIA, on the other hand, tracks the performance of 30 blue-chip stocks in the U.S. Indexes are often weighted based on market capitalization, meaning that the performance of larger companies has a greater impact on the index's overall value. Investors and financial analysts use stock market indexes to analyze market trends, make investment decisions, and compare the performance of different investments. For example, if an investor's portfolio is underperforming a particular index, they may need to adjust their investments or investment strategy to achieve better returns.
Stock market versus stock exchange. The stock market and stock exchange are related concepts, but they are not interchangeable. The stock market refers to the overall system and infrastructure that facilitates the buying and selling of stocks and other securities. It includes all the different types of exchanges, trading platforms, and other entities involved in the stock market. The stock market is a broad term that encompasses the entire network of buyers, sellers, brokers, and traders involved in the buying and selling of securities. A stock exchange, on the other hand, is a specific type of trading platform where investors can buy and sell stocks, bonds, and other securities. It is a physical or electronic marketplace where buyers and sellers come together to trade shares of publicly traded companies. Examples of stock exchanges include the New York Stock Exchange, NYSE, Nasdaq, and the London Stock Exchange. In summary, the stock market is a broader term that includes all the different types of exchanges and trading platforms, while a stock exchange is a specific marketplace where stocks and other securities are traded.
What are the biggest U.S. stock exchanges? The three biggest stock exchanges in the United States by market capitalization are New York Stock Exchange, NYSE, NASDAQ Stock Market, NASDAQ, CBOE BZX Exchange, formerly known as BATS Exchange. Other notable U.S. stock exchanges include the Chicago Stock Exchange, CHX, the Miami Stock Exchange, MS4X, and the Boston Stock Exchange, BSE. However, the NYSE and NASDAQ are by far the largest in terms of the number of listed companies and daily trading volume.
How do you invest in the stock market? Investing in the stock market involves buying and selling shares of publicly traded companies. Here are some general steps to get started. Educate yourself. Before investing in the stock market, it's important to learn about investing basics, different types of securities, investment strategies, and risk management. There are many resources available, including online courses, books, and financial advisors. Set investment goals. Determine your investment goals, risk tolerance, and investment time horizon. This will help you choose the right investment strategy and portfolio mix. Open a brokerage account. Choose a reputable brokerage firm that offers low fees and commissions, research tools, and a user-friendly platform. You will need to provide personal and financial information to open an account. Research companies. Research companies you are interested in investing in and analyze their financial statements, earnings reports, and market trends. You can use research tools provided by your brokerage firm or third-party websites. Buy stocks. Once you have identified a company you want to invest in, you can buy its shares through your brokerage account. You can place a market order, which buys the stock at the current market price, or a limit order, which buys the stock at a specific price. Monitor your investments. Regularly review your portfolio and monitor market trends. You may need to adjust your investment strategy and portfolio mix based on your investment goals and changing market conditions. It's important to note that investing in the stock market involves risk, and there is no guarantee of returns. It's important to have a long-term investment strategy and diversify your portfolio to manage risk.
What is stock market volatility? Stock market volatility refers to the degree of fluctuation in the prices of stocks or other securities traded in a particular market over a certain period of time. It is a measure of the amount of uncertainty or risk involved in investing in the stock market. Stock market volatility can be caused by a variety of factors such as changes in interest rates, economic indicators, geopolitical events, company earnings reports, and investor sentiment. Higher volatility implies that the prices of securities are changing rapidly, making it difficult for investors to predict the future direction of the market. On the other hand, lower volatility suggests that the market is relatively stable, with prices changing more slowly and predictably. Investors who are willing to take on more risk may be attracted to high volatility markets, as they offer the potential for higher returns. However, those who are more risk-averse may prefer to invest in lower volatility markets, where the potential for losses is generally lower.
Investing in stocks. Investing in stocks can be a way to potentially grow your wealth over the long term, but it's important to understand the risks and do your research before getting started. Here are some key considerations for investing in stocks. Understand your risk tolerance. Stocks are a relatively risky investment compared to other asset classes, such as bonds or cash. Before investing, it's important to understand your personal risk tolerance and make sure you're comfortable with the potential ups and downs of the stock market. Do your research. When investing in stocks, It's important to do your due diligence and research the companies you're considering investing in. Look at their financial statements, management team, competitive landscape, and growth prospects to get a sense of their potential for future success. Diversify your portfolio. It's important to diversify your stock holdings across different companies, sectors, and regions to minimize risk and maximize potential returns. Consider investing in a mix of large and small cap stocks, growth and value stocks, and domestic and international companies. Be patient. Investing in stocks is a long-term strategy, and it's important to be patient and stick with your investments through market fluctuations. Resist the urge to buy and sell stocks based on short-term market trends, and focus on the fundamentals of the companies you're invested in. Consider professional help. If you're new to investing or feel uncomfortable making investment decisions on your own, consider working with a financial advisor who can help you develop a customized investment strategy based on your goals and risk tolerance.
Risk of stock investment. Investing in stocks carries a certain level of risk, and it is important for investors to understand these risks before making any investment decisions. Here are some of the main risks associated with stock investments. Market risk. The value of a stock can be affected by factors such as economic conditions, geopolitical events, and changes in investor sentiment. These factors can cause the value of a stock to decline, even if the company itself is performing well. Company-specific risk. Individual companies can experience problems such as declining sales, increased competition, or management issues, which can lead to a decline in the value of their stock. Volatility risk. The stock market can be volatile, with prices fluctuating on a daily basis. This can make it difficult for investors to predict the value of their investments over short periods of time. Liquidity risk. Some stocks may be more difficult to sell than others, particularly if they are not traded frequently. This can make it difficult to sell a stock at a desired price. Currency risk. If you invest in stocks denominated in foreign currencies, fluctuations in exchange rates can affect the value of your investment. Inflation risk. Over time, inflation can erode the purchasing power of your investments, which can be particularly problematic for stocks that pay little or no dividends. It is important to note that not all investments carry the same level of risk, and different types of stocks can carry different levels of risk as well.
Our aim is to help you understand the fundamentals of how the stock market works. If you find our content valuable, we invite you to subscribe to our channel. Moreover, if you have any comments or questions about the topic or want to learn more, please feel free to leave a comment, and we will do our best to respond to your query. Thank you for joining us on this journey.